Welcome to the Deep Dive. You're here for the shortcut to being well-informed, and today we are tackling a story of just extreme ambition.
And even more extreme volatility.
Exactly. We're looking at the Q3 2025 earnings call for Datavault AI Inc., ticker DVLT.
And this call, it wasn't just an update. It was held November 17th, just before the market opened, and it was basically a manifesto.
Right. Our mission here is to really dissect this staggering guidance leap and the huge strategic pivot they're attempting. DVLT is essentially throwing out its old identity.
Completely. They're trying to reposition as an exchange of exchanges.
A term they used over and over, and it's all focused on real-world asset tokenization, RWA, and just aggressive data monetization.
What's so fascinating is the speed of this change. I mean, for years, this company was basically a microcap survival story, tied to legacy audio components, and now overnight, they're using this call to launch themselves as a high-growth infrastructure play.
Mixing Web3, AI, data process.
Everything. They're not just swinging for the fences. They've basically called their shot and said they're hitting a grand slam.
But before we get swept up in that very bullish narrative, we have to start where the street started.
The financials.
The actual numbers.
And they tell a very different story, at least for now. It's a story of growth by acquisition, sure, but paired with really deep structural pain.
So despite all the big talk,
DVLT delivered a huge financial shortfall against what everyone was expecting.
Okay, so let's unpack that miss.
All right. GAAP EPS came in at a loss of 33 cents.
Wow.
Yeah. And the consensus was a loss of 7 cents, so that's a 26-cent miss. A huge miss.
And what about the top line, the revenue?
That was a miss, too. It landed at $2.9 million. The street was looking for something closer to $6 million.
So a clear miss on both, plain and simple.
No way to sugarcoat it. Absolutely.
The headline numbers were, disappointing. But if you dig into where that revenue came from, you start to see the real tension in this story. That $2.9 million, despite being a miss, was actually phenomenal top-line growth. We're talking 148% growth year over year.
And 67% just from the last quarter.
Exactly. But here's the kicker. Almost all of that growth came from a newly acquired live events business.
Right. It contributed something like 2 million of the 2.9.
So they essentially bought revenue. They haven't proven yet that they can organically scale this new high-margin business they keep talking about.
And that leads us straight to the most, let's say, alarming figure on the balance sheet.
The profitability. Or the lack of it.
The lack of it. The company booked a GAAP net loss of roughly $33 million for the quarter.
Let's just pause on that. $33 million in net loss on $2.9 million in revenue.
The ratio is staggering. And when you look at where that money is going, it's the cost of this pivot. SG&A is up, M&A integration costs.
And R&D, right? They have to be spending a ton to build out these Web3 and AI platforms.
Exactly. They're building the things that are supposed to generate all that future revenue, but the cost is now.
Which brought their gross profit down to almost nothing.
A razor-thin $100,000, which gives you a gross margin of about 3%.
3%. That number is the anchor. That's the reality they're operating in right now.
Deep in the red, burning cash, even as they're bolting on revenue through acquisitions. It's a tough spot.
Okay, so the financials were noisy, they were painful. But the management narrative was the complete opposite.
Deafeningly bullish.
The CEO actually called it an incredible Q3 from a strategic point of view. And the highlight of the call, the thing everyone's talking about, was a jaw-dropping guidance raise.
This is the core of the story right here.
Management massively raised their 2026 revenue outlook. They raised it to a $200 million minimum.
Let's put that in perspective. Their prior guidance was $50 million.
So that's a 400% jump. They're projecting, in 2 years, a run rate more than 50 times what they just reported this quarter.
And the CEO was very clear about it. He said the goal was designed to inspire the team.
Inspire or intimidate. They also raised the 2025 floor to $30 million.
And this guidance, it just doesn't make any sense unless you understand the core strategic shift they spent the rest of the call detailing.
They're moving away from the old stuff.
Actively decommissioning it, getting rid of the legacy YSET technologies, the consumer audio, all the stuff that was dragging down margins. They're now focused on two pillars.
Okay, what's pillar one?
First is acoustic science, but this isn't just, speakers. This is about using data over sound for high-value things.
Like robotics or industrial signaling?
Exactly. Think about the difference between selling a speaker, which is a low-margin product, and selling a patented data protocol that lets 1 million robots talk to each other. That's high-margin IP.
And the second pillar, this is the big one.
This is the engine behind that $200 million number, data science. That means high-performance computing, Web3 infrastructure, and the key, real-world asset tokenization.
Right. And for anyone listening who might not be deep into RWA, let's just quickly explain why this is potentially so lucrative.
Please.
You're taking a real asset. It could be anything. Pharmaceutical IP, geothermal energy rights, even a university's NIL contracts for its athletes.
Right.
And you convert the rights to that asset into a digital security, a token, that you can trade instantly, globally, on a blockchain.
And the key here is that DVLT wants to be the infrastructure provider. They're the toll collector on the highway. They're not taking the risk of owning the geothermal rights themselves. They're licensing the tech and running the exchange that lets other people monetize those assets.
Which is where the huge margin jump comes from.
Precisely. And they backed up this huge $200 million number with some tangible deals. They're trying to prove it's not just vaporware.
Okay, so what's the headline deal?
A $10 million worldwide exclusive license with a company called Scilex.
And that's for
genomics and healthcare data tokenization. And that $10 million, that's just the license fee for Scilex to use DVLT's technology to structure their data as a tradable asset.
They also mentioned another one, the Triton geothermal deal.
Yeah, that's another big one.
Yeah.
It includes up to $8 million in setup fees, plus a 5% cut of all transaction fees from a planned $125 million digital token offering.
So you start to add these up, these licensing deals and fee structures.
And suddenly the $200 million target, while it's still audacious, it starts to look like it's rooted in something real.
They also mentioned stacking up partnerships to look more credible, right, with bigger, more traditional players.
Yes, that's key for institutional adoption. They said they're platinum partners with IBM, they're accessing the NASDAQ Q financial framework, and they have MOUs with places like Korea Aerospace University and a Tier 1 defense OEM.
Merck products.
Right. This is all about signaling to serious capital that they're not just some crypto startup. They can handle regulated, secure data.
And this all feeds into their ultimate goal.
Becoming an exchange of exchanges.
They're building these very specific vertical exchanges, one for biotech, one for renewable energy elements, one for NIL contracts.
And the revenue model is the classic one. They want to get paid on every tick of the trade, just like the NYSE or NASDAQ Q. Listing fees, transaction fees, data fees.
If they get volume, that's where the margin transformation happens.
If they get volume, that's the big if. But that kind of ambition, it needs a lot of fuel, a lot of capital.
Which brings us to the investor context, the risk. Liquidity was a huge point on the call.
Central. And their entire strategy here hinges on one thing: an anticipated $150 million Bitcoin-denominated investment from Scilex.
So the same partner from the big licensing deal.
Yes, it's all connected. The investment is triggered by the partnership, but only about $8 million of it had closed by the end of the quarter.
So where's the rest?
It's all pending a crucial shareholder vote on November 24th. They need to approve more shares to issue to Scilex to complete the deal.
And management seems confident the vote will pass.
Extremely confident. They said they have pre-signed voting agreements, and if it goes through, they project it will leave them with $125 to $130 million in liquid assets.
That's the de-risking event.
It's everything. It removes the need to raise equity, lets them retire convertible debt, basically kills the solvency risk conversation overnight.
But let's look closer at that liquidity. They're treating that Bitcoin investment as the same as cash. That's a pretty aggressive treasury stance, isn't it? I mean, Bitcoin is liquid, sure, but it's also incredibly volatile.
It's a high-risk, high-reward treasury strategy. That $150 million could be 120 or 180 by the time they deploy it. And managing that kind of volatility for corporate operations is a huge challenge.
Right. So successfully closing that deal changes the conversation from will they survive to how fast can they execute.
And they have to execute fast because it's tied directly to their forward margin framework.
The one that gets them away from that 3% number.
Yes. They're targeting a 55 to 60% blended gross margin.
Which, again, is a galaxy away from the 3% they just posted.
They know. They argue that as the high margin tokenization and exchange revenues kick in, that blended number will climb. They see the exchange fees themselves having upper 80s gross margins.
Oh, so to hit that $200 million guide and a 60% margin, those exchanges need to be up and running and doing serious volume like yesterday.
That is the core execution risk.
Which is why the market reacted the way it did.
Tell us.
Despite all the bullish talk, the massive funding news, the huge guidance, the stock sold off. It was down about 5.5% in after-hours trading.
Because investors are looking at the $33 million loss and the 3% margin today, and they are heavily discounting the chance of them pulling off this massive pivot.
It's the definition of a high beta story.
Totally. The stock ran up over 300% in the 3 months before the call, just on the narrative. But that momentum is now hitting the wall of reality. And there's still a short seller overhang, the Wolfpack lawsuit.
It's a binary bet. They either get the cash and execute flawlessly,
or they stumble under the weight of the losses and the complexity. The market is just waiting for proof.
All right, let's transition. It's time for our segment where we pitch the most outrageous but plausible trade idea based on this chaos.
And we must say, this is not financial advice. We are just exploring scenarios based on the information from the call.
Given the volatility, a massive gap between the reality and the dream, and the binary nature of this financing, it feels like any trade needs to be high leverage and focused on a single event.
And that event is November 24th. The shareholder vote.
So what's the pitch?
The trade centers entirely on the successful closing of that $150 million Scilex BTC investment. So the pitch is to initiate a short duration, highly leveraged position. Think buying out of the money call options that expire shortly after that vote.
You're betting purely on the vote passing.
Purely. The rationale is all about sentiment and balance sheet validation. Right now, the market is fixated on the Q3 miss. If they successfully close that capital infusion, it de-risks the company overnight. It validates the Scilex partnership. And in the speculative AI and Web3 space, cash equals credibility.
Even if it's Bitcoin.
Especially if it's $150 million worth. Securing that liquidity could trigger a very fast, sentiment-driven re-rating as that solvency risk just vanishes.
So it's a bet that the market rewards the certainty of capital before it demands proof of the $200 million in sale.
Exactly. It's a pure catalyst trade, a bet on liquidity over execution, at least for the next few weeks.
Okay, so let's wrap this up. What does this all mean for you, the listener?
DVLT has swapped its old struggling identity for this incredibly aspirational RWA and AI infrastructure story.
And it's all backed by these big $10 million licenses and the promise of a $150 million Bitcoin war chest.
But the core tension is profound. They're trying to leap from a 3% gross margin reality to a potential upper 80s margin dream.
And the market's immediate reaction was to focus on the miss, on the cash burn. The story they're telling is clashing with the numbers they're printing.
They've set a bar that's deliberately high. It's meant to inspire. So the final question for you is this. Given the complexity of what they're trying to do, launching global exchanges, integrating acquisitions, how much of that $200 million guidance is truly locked in from the deals they have now, and how much is just aspirational? How much depends on perfect execution and hoping the world adopts RWA trading overnight?
That calculation is everything. Thank you for joining us for this deep dive into Datavault AI's massive pivot.
We'll catch you on the next deep dive.